The economics of rental property. Real estate has long been touted as the ultimate wealth builder, but buying a rental property is far more than just collecting a monthly check. In the US, the residential rental market is massive, encompassing over 44 million renter-occupied households. Welcome back to F-Channel Finance. Today we are breaking down the raw numbers, the hidden costs, and the precise financial rules behind owning residential rental property. Part 1: Funding and Acquisition. Buying a rental property requires significant upfront capital. Unlike a primary residence, lenders view investment properties as higher risk. Because of this, conventional lenders typically require a 20 to 25% down payment for an investment loan, meaning you cannot use low down payment programs. You must also account for closing costs, loan origination fees, and appraisal costs, which safely range from 2 to 5% of the total purchase price. Part 2: The cash flow math. The golden rule of rental economics is positive cash flow. To calculate this realistically, seasoned investors rely on two foundational baseline metrics. First is the 50% rule, which states that roughly half of your gross rental income will be completely consumed by operating expenses, excluding the mortgage principal and interest. Second is the 1% rule, meaning a property should ideally generate at least 1% of its total acquisition cost in monthly gross rent to sustain operations. Maintenance and major structural repairs, known as capital expenditures, must be budgeted every month, with experts setting aside 1% of the total property value annually. If you hire a professional property management firm to handle tenants, expect to forfeit an additional 8 to 12% of your monthly gross rent. Part 3: The tax shield. The major advantage to owning rental property in the US is the immense protection built directly into the federal tax code. The IRS allows you to deduct residential property depreciation over a fixed 27.5-year lifespan, letting you write off the structural value of the asset against your rental income. Furthermore, mortgage interest, property taxes, landlord insurance policies, and all direct maintenance costs are 100% tax-deductible expenses. Best of all, when you decide to sell the asset, you can legally defer 100% of your capital gains taxes indefinitely by rolling the profits into another property through a 1031 exchange. Part 4: The disadvantages. But rental real estate is far from passive, and it exposes your capital to heavy operational and legal risks. A single extended vacancy can quickly turn a profitable property into a cash-draining liability, with standard U.S. structural vacancy models averaging 6 to 8% annually. Worse yet is the eviction process. Depending on state-level tenant laws, evicting a non-paying tenant can take between 3 to 9 months and cost between $3,500 and $10,000 in direct legal fees. Finally, real estate is completely illiquid. Unlike stocks, you cannot instantly liquidate a residential home if you face a sudden personal financial emergency. Bottom line. Ultimately, owning a U.S. rental property is a powerful financial business strategy that rewards leverage and tax planning, but severely punishes poor cash reserves. If you prioritize long-term equity growth and massive tax shelters, the landlord path is unmatched. If you want instant liquidity, look elsewhere. If you found this realistic economic breakdown of rental properties valuable, hit that like button and subscribe to F-Channel Finance. Let me know in the comments. Are you actively saving for your first rental property, or do you prefer the simplicity of the stock market?